Hi, welcome to the deep dive. And look, today we're just going to skip the pleasantries and jump right in.
No time to waste.
No time at all. We are looking at a financial situation that is, well, it's forming incredibly fast.
Yeah.
We've got a stack of technical forecasts here, all focused squarely on the Indian market.
Specifically Nifty and Bank Nifty.
Right. And the outlook for tomorrow, January 7th, 2026, it isn't just intense. It feels like a complete reversal of fortune in, the last 2 days.
That is the absolute defining part of this data set. It's a monumental shift. And it happened in, you're right, just 48 hours.
It's incredible.
The source material we have, it starts with this picture of almost reckless, deep-seated bullishness, and it ends with this just stark quantitative warning.
So our mission today for this deep dive is to really piece together these indicators. We're moving from options data to geopolitics.
Which can seem like they're miles apart.
Exactly, but they're not. We want to synthesize it so you, listening, can understand the precise mechanics, the why behind this sudden institutional flight.
The smart money is on the move.
And when we talk about that flight, I mean, there is one data point that just screams. It sets the stage for everything else.
I know exactly which one you're talking about.
The dramatic collapse of the put-call ratio, the PCR.
Yeah.
The speed of this is just, it's astounding. In just 2 trading sessions, the PCR plummeted from an extreme high. What was it, 1.79?
An unheard of 1.79.
Yeah.
Extremely bullish.
Down to 0.80, which is nervous, defensive.
It's not just a correction, it's a structural shockwave. That 1.79, that was a massive, complacent cushion of institutional support.
And now
that cushion has been, well, surgically removed.
And the sources are so clear on this. They called that high PCR a pre-called overbought trap, set at the 26,350 level.
And that trap has now been sprung violently.
And you see the conflict playing out, right? We know the narrative that's out there. You see it on the forums. You see it in the headlines.
Buy the dip.
The retail crowd is buying the dip at 26,150. That's the quote. But the institutional data, it's telling a completely different story.
It's a cautionary tale that completely overrides that emotional impulse.
This is the central theme, isn't it? This dichotomy. Emotion versus the smart money positioning.
It is. And based on all the technicals we have, the battleground for tomorrow is set. It is precisely at that critical 26,000 level.
Huge psychological number.
Huge. And if that barrier fails, the projection is that the selling pressure is going to accelerate dramatically. So this deep dive, it's essential because it explains, with data, why the institutions are now so cautious and why that contrasts so sharply with what the emotional market is trying to do.
Okay, let's unpack that crucial indicator first. Let's spend some real time here. The put-call ratio, the PCR.
The foundation of the whole bearish case.
Right. Because for a lot of people, seeing numbers like 1.79 drop to 0.80, it's abstract. We need to ground this. What exactly is the PCR, and why is this specific drop not just a healthy cool-off, but a catastrophic collapse?
It's a fantastic question. The PCR is arguably one of the most vital metrics you can use. It gauges market sentiment, or what traders call the market's internal health.
The plumbing of the market, in a way.
A great way to put it. At its simplest, you're just taking the total volume of traded put options and dividing it by the total volume of traded call options.
Okay. Puts are a bet on a decline or a hedge against one. Calls are a bet on a rise. Simple enough.
Right. A put gives you the right to sell. A call gives you the right to buy.
Now here's the nuance that always trips people up. Intuitively, you hear more puts than calls, a high ratio, and you think, oh, that's bearish. People are betting on a fall.
And that is usually the wrong way to look at it, especially when you get to an extreme level like 1.79.
Why?
Because you have to think about who is on the other side of that trade. Extreme ratios, they don't reflect the buyers of options so much as the sellers. The writers.
The institutional market makers.
Exactly. So when that ratio was at a sky-high 1.79, it meant there was incredibly heavy put writing, or put selling.
Okay, so let's walk through that. If I'm a major institution and I write or sell a put option to someone, what am I actually doing?
You are selling them insurance. You're essentially insuring the buyer against the price dropping below a specific point, the strike price. And for taking on that risk, you collect a fee. The premium.
And I'm only going to sell that insurance if I'm overwhelmingly confident that the person is never going to need to cash it in.
You are overwhelmingly confident that the index will not fall below that level. You believe the underlying asset, the Nifty in this case, is structurally sound. You're happy to just sit there and collect what you see as free money.
And that brings us right back to 1.79. That number isn't just high, it's a measure of extreme, almost dangerous complacency.
That's the word, complacency. The smart money, the institutions, they had built this massive structural safety net. They were saying, we are so confident in this market, we will personally guarantee the downside at certain levels.
And the source material points specifically to the 26,300 level. That was the floor they were guaranteeing.
Which is precisely why the source called it an overbought trap. Because when everyone is absolutely certain the floor is indestructible.
That's usually when the floor is about to give way.
It's the moment of maximum vulnerability. It means all the bullish bets have already been placed. There are no new buyers left to keep pushing things higher.
They were sitting on this mountain of insurance liability, just convinced no claims would ever be filed.
Yeah.
And then in 2 days, the collapse.
The flight to 0.80.
The speed of it is what's so telling. It suggests that all those institutions decided basically at the same time that the floor they were underwriting was fundamentally unsound.
The implications are just devastating for market confidence. A ratio of 1.80, yes, it means slightly more. Call contracts are being traded now, but in the context of this crash, from almost 1.8 down to 0.8, it means one thing.
What's that?
The source puts it perfectly. The put writers have fled the scene.
They don't want to sell insurance anymore. They want out of the liability they already have.
They want out immediately. The suddenness isn't a gradual readjustment of risk. It's a sharp collective realization that something has systemically changed. The institutions aren't walking to the exits.
They're sprinting.
They are. They're actively closing their short put positions, which means they are buying back the puts they sold. And when an institution starts buying puts,
It pushes the PCR ratio down even faster.
and that reinforces the bearish momentum. It's a feedback loop. The PCR crash isn't just a reflection of fear, it's an active ingredient contributing to the selling pressure.
So the big psychological takeaway here is just the loss of the floor. That confidence backed by billions in capital, that was protecting 26,300. It's gone.
It's just vanished. And it sets this incredibly dangerous precedent. The very same institutions that were guaranteeing stability are now, by their actions, confirming deep instability.
So for anyone trying to understand this, this is your first and clearest signal. The prevailing belief in a solid market floor is, for right now, technically and financially unsupported.
And if the market can't find anyone willing to underwrite that downside risk, the depth of any fall becomes, well, completely unpredictable.
Okay, so the PCR gives us this breakdown of internal confidence, a crisis of confidence.
A complete evaporation of it.
But let's look for external confirmation. Panic rarely travels alone, right? We need to look at the supporting indicators. And the environment is very clear. The price is falling.
But at the same time, the India VIX, the volatility index,
The fear gauge.
right, it's rising sharply.
And this VIX factor analysis is just, it's so critical. It confirms this isn't just profit taking. This is structural.
It is. The data shows the VIX is up nearly 10% in just 2 sessions. It's sitting at 10.21.
Now, in a normal, healthy bull run, volatility tends to go down as prices grind higher, right?
Correct. Volatility and price usually have an inverse relationship in a bull market. Volatility spikes when things get scary, during sharp corrections or crashes.
So when the price is falling and the VIX is spiking at the same time, it's basically the market shouting at you. It's saying the selling is not soft, it's not gradual, it's not retail driven.
It is the first formal alarm bell. And our source material explicitly calls this the first sign of institutional distribution.
Okay, we need to go beyond the textbook definition of that term. What is institutional distribution, really?
It just means that the large, informed players, the big funds, they're systematically offloading huge blocks of shares into the market.
But they can't just hit the sell button on 1 million shares at once.
No, absolutely not. A panicked retail trader might do that, but an institution can't. They'd crash the price on themselves before they could get out.
So how do they distribute quietly? Or less quietly, in this case?
They use algorithms, dark pools. They try to minimize the immediate market impact. They'll spread small sell orders across dozens of platforms over days or even weeks. But here is the crucial point.
Okay.
When they decide to distribute, they become extremely sensitive to downside risk. So what do? They aggressively buy puts to hedge their massive physical stock holdings that they are trying to sell.
Ah, there's the link.
That's the link. The hedging activity, this institutional insurance purchase, is what directly fuels the VIX spike.
So they're selling the actual stocks, which drives the price down.
And at the same time, they're buying the insurance. which drives the VIX up. It's a conscious, calculated, two-pronged move. It shows real conviction on the bearish side.
They believe the downside is so substantial that it's worth paying for this very sophisticated, expensive hedge.
Exactly. And while a VIX of 10.21 might seem low if you're looking at, historical crisis peaks.
Like 2008 or 2020.
Right. It's the rate of change that matters here. A 10% jump in 48 hours is what signals the abrupt shift in their calculus. Institutions don't move their hedges that fast for simple profit-taking. They are reacting to a fundamental change in perceived risk.
And now we have to connect that change in risk to the global environment, because the source material singles out a very specific factor.
It does.
The U.S. operation in Venezuela. Now, for the average trader watching the Nifty in Mumbai, this might seem peripheral, totally disconnected. Why is this event no longer just noise? How is it confirming the instability that the VIX is signaling?
This is where you have to synthesize the macro picture with the market structure. India is a massive net energy importer. Its entire economic stability is deeply linked to the price. And, just as importantly, the certainty of the global crude oil supply.
And Venezuela, despite all its issues, sits on some of the world's largest oil reserves.
The largest. So any significant U.S. operation there introduces immediate dramatic uncertainty into that global supply chain.
So the market isn't just reacting to the price of oil today. It's not saying, oh, crude is up $10.
Yeah.
It's saying the chance of a catastrophic supply disruption in the future just went up exponentially.
That is precisely it. The market impact, as the source states, is that we are now pricing in a structural shift in energy costs.
A structural shift. That sounds permanent.
It means that even if crude prices stay flat tomorrow, the risk premium associated with doing business in India has gone up. And it will stay up until this geopolitical situation gets resolved.
Let's elaborate on that. What does that risk premium, that structural shift, actually mean for the Indian economy? What's the domino effect?
Okay, so first, it puts immediate pressure on the rupee. If oil supplies become more expensive or just more uncertain, India needs more U.S. dollars to secure them. That can widen the current account deficit.
Right.
Second, domestic inflation expectations rise. Nearly every sector, from manufacturing to basic transportation, it all relies on energy. Costs go up across the board.
And third,
The Reserve Bank of India suddenly has less room to maneuver. They might have to consider rate hikes to combat that inflation, which...
puts a brake on the economy.
Exactly. So the institutions who are distributing their positions, they're not just selling because of a domestic PCR crash. They are systematically removing their exposure to these potential macro shocks.
So the VIX spike is the final confirmation. It's the market telling us that the big players see this Venezuela story not as a passing headline, but as a genuine, non-domestic structural instability that demands immediate risk reduction.
That is why the source says it is no longer noise. It's a fundamental repricing of future economic certainty. It ties the domestic option dynamics right into the global political landscape.
Okay, so let's pivot now. We've talked about the psychology, the internal health, the global environment. Let's look at the actual price action.
The tape.
The cold, hard facts on the chart.
Technical analysts. They read the market like a story, and our source material says a specific chapter just ended. There is concrete evidence that the previous bullish trend is formally broken. What is that evidence?
We're zooming in on the 15-minute chart for this. That gives us the high-definition view of momentum.
Okay.
The foundation of any strong bull market is simple. It's a consistent series of higher highs and higher lows.
It's like climbing a staircase. Every step is higher than the last one.
A perfect analogy. Buyers are always in control. They can always push prices past the previous peak, and they can always defend a higher low point.
But that's not what happened.
That is not what happened. When Nifty failed to make a new high, and instead printed a lower high at 26,340, it broke that sequence.
The staircase is broken. The staircase is broken. That single failure is the market structure changing in real time. It tells you that the sellers who were waiting at that level were more powerful than the buyers who were trying to continue the rally. Control shifted.
So that failure at 26,340, that's the moment we can stop calling this a dip or a correction and start calling it a potential reversal.
For the